In this week's update, it would be incredible if the S&P 500 were not at record levels. Rotations are tricky, but signals a very strong market, and the third in the educational series. My name's Garry Davis, and as always, this is general advice only, and please remember to like and subscribe to the video. All right, let's start with a quick perspective. US market valuation, and in fact global stock market valuations, are getting plenty of attention at the moment because the prices have gone up. They're all at record highs. And so the natural extension is people think that the market is expensive. It has to be expensive because it just keeps going up and up. But it's actually very misleading to look at it that way. The reality is that earnings are being smashed. They're being beaten very, very easily. And that was against already upwardly revised figures. Analysts have been scrambling all year to raise the earnings expectations and the revenue expectations, and they just haven't been able to keep up. And the end result was, with US earnings season almost finished, that roughly 87% of stocks have beaten earnings estimates, and that's an incredible number. So we've got analysts scrambling to raise estimates, can't keep up, earnings still smashing estimates, forward guidance being raised. We've got rates at low levels. Yes, they might go up to a degree, but they'll still remain at very low historical levels. And we've got government stimulus and central bank stimulus on max setting. So when you look at the current values in that context, it's pretty easy to see that the US market is quite probably not overvalued at all, as many people are telling you. And my view of it is that how could the market not be at this level? I think is the more accurate way to look at it. It's exactly where you would expect it to be. Now, we're not really getting any sector breakdown. So what we've had all year, in fact, since roughly November last year, when the vaccines became available and we got a bit of a reopening theme that ran for a while, is that we're getting these periodic rotations from sector to sector, and that is actually doing the work. We've got like a rolling correction or a rolling pullback, if you like, from sector to sector, which is preventing any sector from getting too overheated. And that's really doing the work of a general market correction. And so hence, we don't really have a valuation problem. All sectors have had some periodic weakness. It's tended to have been fairly short-lived. It's quickly stabilised and then basically moved on to new highs. So that's the overall perspective of the market. American stocks, the S&P edged forward another 0.5% across the week. Financials are performing very strongly. The yield fell all the way to 1.12%, and then it started to bounce last week, and it's now up to about 1.3 from memory. So with that turn up in the yield and the market anticipating that perhaps the 10-year yield has bottomed out at around that 1.12 level and is now going to head back up again, then that's obviously good for banks. And so the financials did very well. One of the difficulties that traders and investors have got in this sort of environment is that the rotation from sector to sector seems to be happening faster and faster. And so where previously we might have had 6 months to a year where a particular sector would run along in positive mode and then you get a correction, now that's coming down to months or even in some cases down to weeks before the hot money moves on to somewhere else. And that makes it pretty tricky. And it also makes it really important that you're very clear about what you're doing. What are the sort of stocks you're buying? What is your game plan? How do you buy them? How do you take profits? All those sort of things just so important, because otherwise you'll be in a state of confusion. You'll be chasing your tail the whole time. Now, the US dollar made a very mild gain late in the week, up to 92.63. The 10-year yield was pretty much steady, around about 1.3. And the VIX dropped down a little bit further, down to 15.5. It's not 2017 where we saw the VIX consistently under 12, but it's still pretty low on a long run historical basis. All right, let's look at some charts. Just have a quick peek at Bitcoin to start with. Bitcoin appears to have fooled everybody. False breakdown under 30,000, which is what everyone was looking for. And then as soon as that happened, it turned around and there was what appears to be a big short squeeze. And it finished at 44,500 US dollars on Friday night. All you can say is we've got higher highs, higher lows. We've got a breakout above the previous resistance at 40,000, and who knows, we may technically head back up here towards 50,000 before it completes this part of the cycle. Now, looking at the S&P, you can see new all-time highs, only just a point or two off the absolute high for the week. And if you look at the orientation of the moving averages, the green 20, the blue 50, and the red 200, they're all lined up perfectly. And the value of the index is above all three of them. So that's just a perfect orientation. It's a great trend. There's no sign of the trend waning. There's no sort of rolling over or flattening out. It just looks super strong. And as I said at the start, there's every reason why it should do. There's the NASDAQ, just lagging a little bit in the last week or two because we've had this partial rotation back into financial stocks, and we'll have a look at that. So XLF, so you can see financial stocks, new all-time highs. It's only a minor breakout at this stage, but typically when the finance sector starts to run, it runs for some time and for some distance. So I would expect that this is probably a bit of a sustainable trend that we're going to see for a little while. The other important index, of course, is what's happening with the small caps. Now, the small caps definitely have lost relative strength compared to the larger cap stocks. And the Russell 2000 is at the same level as it was in February. So we've just gone sideways, and you can really see it at an individual stock level. The stocks that are trending consistently are almost exclusively large caps. We're getting little bursts in some of the small caps, but it quickly runs out of legs and collapses back down again, particularly in a lot of the technology growth stocks. So certainly larger cap stocks in America is the place to be. And if we look at some of the important spreads, this is the Russell 1000 growth versus value. You can see we're still closer to the top of the range. It's just come off a little bit last week, but is still going quite well. And I don't see that situation changing. I think there will be probably an equal balance of investor money into both value and growth stocks. I think that's just the sort of market that we're in at the moment. And if we look at, of course, the consumer discretionary versus consumer staples, which is a very good lead indicator, as I covered a couple of weeks ago, for the long-term health of the market. And at the moment, consumer discretionary is certainly holding its own against the more defensive consumer staples sector. Just turning now to the US dollar. So we had a little bit of a pullback on Friday in the US dollar, and that caused a bit of a tick up in the Australian dollar. But you can see we haven't really formed any higher highs here. We're still in downtrend. We've got a little consolidation has happened over the last 2 to 3 weeks in the Australian dollar around the 73 mark, but no indications yet that we've found a low in the Australian dollar. Aussie Stocks 73.34 is where we finished, and our index rose by 1.2%, largely thanks to healthcare and the banks leading the way. Materials and energy sectors of the market, at least as far as the majors are concerned, struggled on a relative basis. But look, the dominant theme at the moment is battery materials, particularly lithium, but it's filtering into nickel and copper and graphite stocks, rare earths. It really is very, very buoyant, both at the producer level, but also at the explorer developer level as well. So the ASX 200, you can see very robust finish to the week, and that's largely a result of quite a kick up in healthcare stocks. They did very well on Friday, but if you look at the banks certainly led by Commonwealth Bank have setting new all-time highs now, whereas energy is lagging on a relative basis, and it's now dropped below its 200-day moving average. And if we look at the other major sector, this is materials. Materials still heading up. It's still doing a lot better than energy, but with some question marks over the iron ore price, I think materials is probably going to struggle at the large cap level. Turning now to precious metals, gold was up $15 to $17.80. It's been a huge roller coaster over the last few weeks. We saw a big plunge at the start of the week and then some recovery. I guess my feeling at the moment is I'm scrambling around looking for what it's going to take to get gold moving again, because the environment for gold doesn't get a heck of a lot better than this. We've also got positioning in the futures market, which should be close to a low and a turning point in the market. But we've been in that situation now for half a dozen weeks, and the market just doesn't seem to want to go up. So on the one hand, I'm struggling to see what's going to get gold moving again, because this environment is just so positive for it. But on the other hand, I also know from a contrarian point of view that when you start to think that, what is going to make this market turn around, and you start to lose hope that it's ever going to happen, is generally pretty close to when it does happen. So I'm not giving up on gold yet, but certainly any exposure you have to the gold sector should be pretty modest, if any, and wait until the market shows us some more positive signs. Turning to GDXs, we'll see the setup just looks very ordinary at the moment. It's very difficult to justify having much exposure to the sector. So if we look at there is gold on a daily basis. So we had a huge plunge which started on Friday, August 6, continued on Monday, August 9, went virtually all the way to the bottom, formed a double bottom. So this looks pretty technical to me, and then it bounced very hard and actually finished up on the week. But certainly Monday was a huge range from 1760s and got down to 1685. So about $85 plunge on Monday in gold. If we look at it on a weekly, you can see there's our double bottom now. Whether this is the bottom or not remains to be seen. Sorry, that didn't work. There we go. So you can see where we may have formed a double bottom, but at the moment I'm not really seeing anything that that's highly encouraging. Silver's starting to break down. We're starting to form some series of lower lows now. So silver has stopped looking more positive than gold. And if we look at GDX, you can see it's a pretty ordinary looking chart. So I think just leave the gold sector on the sideboard for the moment. Turning to other commodities, copper was steady, nickel went up a little bit, and with the situation with copper at the moment, we've got about 7% of global copper supply at risk because of strike actions in South America. So that should keep some sort of upward shorter term pressure on copper. And then of course the long-term situation for for copper and for nickel is extremely positive, and with deficits getting bigger and bigger through towards the end of the decade. However, the situation with copper in particular is that it's being those strike actions in South America are being offset by lockdowns in Asia, in China, Japan, and elsewhere, and of course that's reducing demand. So we've got a sort of a bit of a balance there at the moment. Crude oil was steady, just a tick over 68, and XLE, which is the energy index in America, was effectively flat. There's the copper chart, no real change there, and nickel just edging up during the week. All right, let's move now to the third part in this educational series, which is really being done at the concept level. So just a quick recap of last weekend. The key points were that if you look at just single financial data points, you look at a PE ratio or something of that nature, and you look at it in isolation, I think it's worse than not doing it at all, because a single data point can give you an impression that a stock might be cheap or expensive or whatever, and you form an opinion about that stock based on that single data point that could be completely misleading. So I would encourage you, if you're doing any sort of financial data work, that you either do it properly or you don't do it at all. And doing it properly means that you need to examine trends over probably at least 3 to 5 years. And then you also need to understand the company and the environment that the company operates in well enough that you can put that financial data and those trends into context. You've got to understand what the future it looks like for that company, because the financial data is reflecting the past, whereas the markets are pricing based on the future. So you do need to understand that context. And we also looked at the best way to recover lost ground. The concept of if you're well behind on a stock and it's trending down, then you've already lost that value. The only question is, what is the best way to get that value back? Is it in that stock, or is it in some other stock that is trending upwards? And when you think of it that way, the answer is pretty obvious. And as I've mentioned, these bits of educational concepts are all going to be brought together in far greater detail probably in about 2 to 3 weeks' time. But more on that as we get closer. So for this week, it's really looking at a model that I think works really well, and that's having a core position and also a trading position. It's the most psychologically friendly way to deal with volatile markets. If you take a meaningful position in a high growth stock or in a speculative mining stock that might have a lot of upside, then one of the almost certain consequences of that is that along the journey, you're going to have very significant pullbacks from time to time. And some of those pullbacks can be 30, 40, 50% and more. And most people can't deal with that psychologically. We think we can when we buy the stock, but when the stock has fallen 50%, most people get weak in the knees and sell out. So, it's great to have that idea that you're going to sit on something for 5 years. But, I've been doing this for a long, long time, many decades, and dealt with, worked with a lot of traders and investors. And very, very few people can stay the course when prices start falling. So this idea or this concept of splitting your holding into a core and a trading concept allows one to relax through the pullbacks, because the core position should be sized to a level where you can feel comfortable during a very significant pullback. And the trading portion, the entries and exits, should be based around very, very clear rules that don't really require any on-the-run decision-making. The decision-making's already been made before you bought it. So it really should eliminate agonising decisions about what do I do with this stock that is either going up rapidly or going down rapidly. And of course, the other advantage is that you can use the trading portion. If you buy low and sell into strength, then you've made a short-term profit. And every time you do that, you effectively reduce the initial value of what you paid for the core position. And so your core position gets cheaper and cheaper. So I just think it's a really good way to go about it. So the way that I go about it is to size my core position, which will allow me to sit and hold for 1 to 3 years. And I'm going to sit and hold no matter what, whether the stock price goes down because of just normal fluctuation or because there's a general market correction. So I'm committed. My conviction is high on that particular stock, and I'm committed for the medium to longer term. The trading portion takes advantage of shorter term fluctuations and allows you to have larger exposure to what can often be very powerful long-term themes, and we're seeing plenty of those, not only in technology but obviously in decarbonisation as well. And my rules about how I get in and how I get out are very clear, so there is never any indecision about how the trading portion actually works. And as I said earlier, the profits from trading portion, if you do it well, progressively reduce your core price. And again, that makes it easier and easier just to sit on the core portion when things might be going against you. All right, so when we look at the core position, the entry price is less critical because you're going to be in a high growth stock, or what you hope is a high growth stock, for several years. So whether you paid 80 cents or 90 cents, if a stock is going to $5 or $10, is really neither here nor there. So your entry price is less critical. You can just establish your position, get a seat on the bus, and let it go. The only point I would make is you want to try and avoid buying after a surge. So the entry price is less critical, but don't be too cavalier about it. When it comes to the trading portion, there are 3 attractive entry patterns that I would define. And the key thing here is know exactly what your best setup looks like. I get lots of questions from members and others, and it's pretty clear to me that they're really just sort of grasping at something that might be a possibility rather than responding to very, very clear chart patterns that they look for. But again, there'll be a lot more about this with plenty of examples in the final product that'll come out of this education. So knowing what your best setup looks like is very important. Now, in the next video, I'll be focusing a bit on the concepts around taking exits. There's no question this is a task that perplexes investors the most. It is the single most difficult thing that traders and investors have to do. And again, the more that you can reduce that task to clear signs, clear rules, then the easier it becomes and the better your results should be. All right, final thoughts to wrap it up. The reality of the US market is that and this is again looking ahead now into financial year 22, which is what the market pricing is reflecting. It's likely that the current financial year 22 earnings estimates are still going to be significantly too low. Analysts haven't been able to catch up all year. The number of stocks that beat estimates and beat estimates by a long way and then further raise guidance is proof that analysts still haven't caught up, and I think they're going to prove to be too significantly low. We're overdue some technical weakness. We're in a time of year, the seasonality, August, September is spot on for some weakness. So I wouldn't be at all surprised to see a bit of a pullback. But the strength the market is showing, I'd like to bet that we're not going to see too much of a pullback. But looking forward to 2022, it's hard not to be bullish. It really is. And in secular bull markets, the reality is that levels of resistance tend to be broken to the upside. That's what creates a secular bull market. Yes, you get corrections, sometimes substantial corrections of 30 to 50%. But when we're in this sort of phase of the market, when we've got economic expansion, then levels of resistance tend to be broken and levels of support tend to hold. Portfolio analysts last week, I had a week off, a week in limbo to recharge, but the portfolios performed very strongly, and there's just opportunities everywhere. So many terrific mega trends, so many terrific growth stocks that have got high probability of achieving their objectives. So it's a very exciting period in the market at the moment, and I'll just leave you with a thought that just the clearer you can become about your game plan, then the more productive your market activities are likely to be. So that's it for this week. There's the website address and my email address if anyone wants to contact me, and I'll be back with you next week. Cheers.